Welcome to this explainer. Today, we're diving into exactly why the stock market suddenly swings wildly in the middle of the week. When it acts way more like a casino than a normal financial institution, seemingly out of nowhere. We're going to map out the domino effect of short-term options trading. It's this fascinating hidden mechanism that has completely rewritten how Wall Street operates. And hey, by the end of this, you're going to see exactly what is happening behind the scenes on a random Tuesday. Let's get right into it.
Okay, let's quickly map out our journey for today. First, we'll look at the era shift, then break down the mechanics, explore the feedback loop, check out market distortions, and finally uncover the hidden risks.
Let's kick things off with part 1, the era shift, from monthly to mid-me. So for decades, the stock market operated on this highly predictable schedule. Options contracts, which, just as a quick refresher, are financial contracts giving you the right to buy or sell a stock, well, they historically expire just once a month, or eventually once a week on Fridays. But we've totally shifted away from that old-school waiting game. Now, financial exchanges list single stock options that expire on Tuesdays, Wednesdays, and Thursdays. You can literally trade options every single day of the week. It's a whole new world.
And these midweek options, they act like incredibly cheap fuel. They allow everyday traders just like you and me to speculate on immediate corporate news, think an Apple product launch or a huge Tesla earnings surprise, without paying the hefty premium of a longer-term contract. Because these specific contracts expire in just 24 to 48 hours, they cost significantly less upfront. So this allows retail investors to jump in on sudden news instantly, making continuous daily trading a reality for literally anyone with a brokerage app on their phone.
Moving on to part 2, the mechanics, the physics of short-term trading.
To really understand why this cheap fuel is so explosive, we have to look at our first sort of law of physics here, time decay. Imagine an option like a melting ice cube. Normally that melting takes weeks, maybe even months. But with midweek options, the clock is literally eating away your contract's value hour by hour, right before your eyes. This means you are losing money on the contract's premium, even if the underlying stock stands completely, absolutely still.
Now combine that incredibly fast-ticking clock with something called gamma acceleration. I know, it sounds like some crazy sci-fi weapon, right? But the core concept is actually super straightforward. Right before expiration, even a microscopic, tiny change in the stock price causes a massive, violent change in the option's value. It essentially turns a tiny ripple in the stock market into an absolute tidal wave in the options market as that deadline closes in.
Which brings us to part 3, the feedback loop, a market chain reaction.
So think about this. What actually happens when you throw millions of retail traders into an arena governed by these wild, volatile mechanics? Well, before we trigger the dominoes, let's meet the players. First, we have retail investors. That's everyday traders acting as the catalyst by buying up all these cheap options. Next, the market makers. These are the massive financial institutions acting as the house. They take the other side of your trade just to provide liquidity. And finally, the algorithmic systems. These are institutional computer programs designed to spot trends and just ride the momentum.
Okay, here's how the entire system literally catches fire. Step 1. Thousands of cheap retail options are bought up, which immediately forces market makers to rapidly buy the actual stock to cover their own risk. This forced buying artificially rockets the stock price upward. And guess what? That triggers the algorithms to jump in, pushing the price even higher in this massive, vicious loop. Then, as the afternoon deadline approaches and traders close out their positions, the market makers dump the stock, triggering these abrupt, crazy intraday reversals right before the closing bell rings.
Let's dive into part 4, market distortions, the real-world fallout.
Let's step back for a second and look at how this highly technical feedback loop fundamentally alters reality for absolutely everyone. The sheer scale of this is wild. We are talking about massive, fundamentally sound companies experiencing sudden 5 to 10% intraday price swings on a random Wednesday, with absolutely zero major news. I mean, the company didn't release a new product, their earnings didn't change, yet their stock is flying up or down solely because of options mechanics. That's just crazy to think about.
And the impacts here are incredibly sweeping. We're seeing distorted stock valuations that are completely disconnected from a business's actual financial health. Plus, we're seeing heavily surging trading volumes strictly from Tuesday to Thursday. What does this mean for you? Well, if you're just a standard investor trying to buy regular shares during these high-volume periods, you end up paying a higher spread simply because the options market has temporarily distorted the company's true valuation. You're basically paying a hidden tax for a game you aren't even playing.
And finally, part 5,
Hidden risks, the fast track to zero. Now, for those of you actually stepping into this fast-paced midweek arena, we really need to bluntly examine the severe personal risks. And this isn't an exaggeration, folks, because you're holding a contract that expires in mere hours. A minor miscalculation doesn't just mean a temporary dip in your portfolio that you can patiently wait out. No, it means a total 100% wipeout of your money by the afternoon. If the stock doesn't move exactly as you predicted, that contract expires completely worthless. Boom. Gone.
Beyond that threat of total loss and extreme time decay we talked about, you also face execution slippage. That just means the price is moving so unbelievably fast you might not even get the trade filled at the price you want. And perhaps the scariest part? You face massive assignment risk. Holding a contract just 1 single cent in the money, meaning the stock crossed your target price by a penny right at closing, could force your broker to automatically execute it. You could wake up unexpectedly buying or selling thousands of dollars of actual stock overnight.
Which leaves us with this final, pretty provocative thought to consider before you make your next trade. When you buy midweek options, are you actually analyzing a business and investing in its value, or have you just become another necessary gear in the market maker's volatile feedback loop? Understanding the hidden structure behind your screen really is the only way to navigate this incredibly fast, new era of trading. Thank you so much for diving into this explainer with me. Keep that focus sharp, and I'll catch you on the next one.